my name is Mary Kayadu, and this is Corporate Financial Analysis. In this particular session, we will be dealing with the DuPont analysis, which is an analysis of profitability. So, upon completion of the session, you should be able to explain the meaning of DuPont analysis and also examine the various elements of the model. Now, one major way of analyzing profitability of companies is by using the DuPont analysis. And this analysis is used to determine the financial performance of firms in terms of profitability and efficiency, as well as leverage. Now, let's decompose the model and explain the various elements it is comprised of. And the DuPont model was created in the early 1990s, but it is still very valid to use in order to assess profitability of firms. And the model was created by Donald Z. Brown, who came up with the model when he was assigned to clean up the finances of General Motors. If you don't know, you'd want to read about it. And ever since that, it has been an important model for financial analysis. So there's been cases where firms window dress the financial statements, but as an analyst, you'd want to go a step further to critically examine these financial statements to make sure that users who rely on them are making or are able to make informed decisions in terms of investment and also economic decisions. Now, the idea behind the model is that return on investment is the best overall financial performance measure, and that all activities of organizations ultimately contribute to the return on investment. So one of the main goals that firms seek to achieve is to increase or to maximize shareholders' wealth. And the agency problem comes in when managers do not act in the interest of shareholders, but act on other reasons or when they have conflicts of interest. Now, the greatest returns you could actually give to shareholders is to actually maximize the investments they have made, and that's by giving them returns on their investments or giving them returns on equity. Now, returns on investment depends on the net profits and the capital turnover. So the DuPont analysis is used as a tool to measure managerial performance by linking their net profits margin to their total asset turnover. So the DuPont model is an extension of the return on investment ratio, which measures overall profitability and operational efficiency of firms. In that, this particular analysis considers the interrelationship of accounting information that is being given in financial statements. So the model is usually useful in segregation and identification of factors that affects the overall performance of the company, including its operating activities and financing activities, as well as investment activities. Now, the DuPont analysis is a type of analysis that examines a company's return on equity by breaking it into three distinct components: the profit margin, the asset turnover, and the leverage factor. So the return on equity is simply a function of the net profit margin, the asset turnover, and the equity multiplier. So the higher the return on equity, that's a positive sign to show that the firm or the company has good financial performance or is in good financial standards. So net profit margin is equal to your net income divided by your sales. Your asset turnover is your sales divided by your assets. And the equity multiplier, which is also used to measure the leverage the firm has, is simply your total assets divided by shareholders' equity. And I know why you know it's total assets. Like the basic accounting equation, assets is equal to your capital plus your liabilities. So your ability to manage or make the maximum advantage out of these is how you leverage as a firm or a business. Now let's decompose the DuPont model into its separate parts and then discuss them. Now, when it comes to profitability, that is measured by the net profit margin. You calculate it by dividing your net income by your sales. Now this shows the net profits that FM earns for each CD of sales it generates after deducting other expenses like the selling and administrative expenses, overhead expenses, and also after accounting for interest and taxes. So the profit margin is usually a direct result has a result of competition that the company faces. So in previous sessions, we made mention that the company can enjoy comparative advantage or competitive advantage. And with respect to the competitive advantage, Michael Porter listed five forces, including the threat of new entrants, bargaining power of suppliers, bargaining power of buyers, and all that. So you want to know that in highly competitive industry, the profit margin may be lower, and in industries where the competition is low, you'd have firms enjoying very high profits. Also, when it comes to the asset utilization or operating efficiency, or usually known, or in this case known as the total asset turnover, you calculate it by dividing your sales by the total asset, and it is used to measure how efficiently or effectively management is able to drive sales from the company's assets. So how efficiently is the company able to generate more sales from the assets it has, be it fixed asset or um current assets and both non-current assets. Now a company can be very profitable but not too efficient, so you can be making a lot of profits but using a certain amount of resources, but you can equally make more profits without wasting a lot of assets or resources. And so higher margin companies are able to generate the same absolute CD of earnings using lower volumes, but low margin firms need higher volumes in order to achieve the same net income. So there are firms that can make a lot of income with lower volumes of sales, but there are people who also have to make a lot of sales before they can generate earnings. So you want to know what kind of company, um, like what kind of margin your company falls within. Are you in the high margin company or a lower margin firm? So you want to assess all these. Also, when it comes to leverage or the equity multiplier, it's calculated by dividing your assets by your total or by your shareholders' equity. And this is used to measure the amount of debt a firm uses or its leverage. In the previous session, we mentioned that your ability to generate more returns from borrowed funds than the interest you have to pay on those borrowed funds is your leverage. So the higher the ratio, it means the more debt that the company employs in relation to shareholders' equity. And note, the more debt you employ, that it could lead to the possibility that the firm will become overburdened with debt and they might not be able to keep up with interest payments. And once the firm starts defaulting or is not able to make its interest payments, then the firm might become distressed. And when you get it into distress, that means you would have liquidity issues and you'll be having solvency problems. If care is not taken, the firm will be forced into bankruptcy, and that will not be good. So, in assessing the DuPont model, these are the three items you take note of, especially in terms of profitability, operational efficiency, and also leverage. So in this session, we discuss how to analyze profitability using the DuPont model, the various elements of the model, that's the net profit margin, the asset turnover, and also the equity multiplier. And we also explain the meaning of DuPont analysis. Thank you.